Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can understand what we see in the global landscape. Well, the correction that we had back in October, September, down around 10% from the market highs, about 85 to 90% of that now has been recouped back to the upside. I want to talk about this again for a simple reason. Investors tend to be emotional. Nobody ever wants to see their money go down, ever. I've talked to a number of clients over the last month. They received their quarterly statements. You know, they might have had $1 million and they noticed, wow, we're down $65,000 on our million. Those are shocking numbers, and I realize that. But at the end of the day, corrections are normal. We're not looking for any recession currently. We're looking at a recessionary indicators very strongly every single day. We will raise significant amounts of cash and gets very defensive, so we can hopefully avoid any big drawdown in capital if we do get a recession, but we see nothing currently in sight. Garden variety corrections happen every single year. And I don't care if you're a conservative investor or you're an aggressive investor. I go back to investors tend to be emotional. The majority of our clients, I think, are fairly level-headed, but emotions do come into play from time to time when you open your statement. So realize that. I try to educate investors, not only on my TV, radio show, but all of our clients. The only chance you have to make a real return on your money is look at the average over 3 years. Over a 3-year time frame, you could have a year that you're down 6-7%. You can have a year you're up 18, and the next year could be up another 12. You've made a great return. The bottom line is this. If you're expecting every year to always be up, if you're expecting never to have volatility, if you think being more conservative is a great way to go, unfortunately that's wrong. Are you going to invest in 10-year treasuries right now that are paying 2.25%? Probably not. But even if you did, you still have risk. In fact, let me give you a couple statistical notes. If I look at 10-year treasuries or even the 20-year, the TLT, which represents an ETF that buys 20-year treasuries, if you look at about a month and a half ago, and you look how interest rates have gone up just about, let's say, a little over a quarter point on that 20-year treasury, investors just lost approximately 2.5 to 3 years of their interest from the loss of capital from interest rates going up. Remember, bonds go down just like stocks can go down in all asset categories. So the key is relative strength. Sometimes you're going to have some distortion in that portfolio. It's going to be natural. The key is this. If you need income, and I've talked about this many times with my clients, we want to have at least 3 years conservative money that is subject to any real big volatility. Things like cash, short-term bonds, floating rate securities, things that are much less volatile. But ultimately, whether you're 60, 70, or 90, at the end of the day, 3-year increments of return are what's really going to pay off for investors, in our opinion. I feel investors will be successful as long as they're not emotional and do the wrong things at the wrong time. I want to bring back a story before I talk about the general economy. This is a client that we lost about a month and a half ago. And I want to talk about us losing an actual client so it educates hopefully the rest of our clients exactly what not to do. This was a newer client. He was managing partial of his money himself. We were managing the majority of his money. He made a lot of bad decisions with his personal money, and he told me he was down 30% year to date with his personal money he was managing. He thought the world was coming to an end, so he wanted to liquidate his portfolio with us exactly at the bottom of the market around that September timeframe. What's interesting is he was only down 7% with us. He was down 30% with his own. He would have recouped his loss already if he wouldn't have done anything emotional, but he told me that the world was coming to an end and he thought something bad was going to happen. He is no longer a client, and he incurred what's called permanent capital loss. He sold at exactly the wrong time because his emotions were affecting him. If an investor is emotional, they'll never have a chance to make any real return on their money because they're going to jump from advisor to advisor to advisor, and they're going to sell at exactly the wrong time. It's not greener on the other side of the fence. Everybody's going to have some volatility, no matter who you work with. The key is make sure you're working with a real money manager who actually cares about risk management in the long run. The major risk you have, folks, over the long term is recessionary risk that brings down your portfolios. We're watching that closely. The economy's doing well. Unemployment's doing well. Housing, auto, retail's doing well. Generally speaking, the U.S. economy's in a nice uptrend. We like what we see, but we're watching our recessionary indicators very close. If you're a client of our firm and you have any questions or concerns, call us, talk to me on the phone. If you're not a client, it's time you became a client. There is a difference. Make sure you have yourself a safe and profitable day, and make sure you watch my TV show on Saturday and Sunday mornings and my live radio show this Sunday from 10 a.m. to noon throughout Florida. Have a great day.